Welcome everyone. Thanks for coming along to listen to our first set of results since we floated on the stock market. So before Ashleigh and I talk about what happened in FY21, just for a few of you may not be so familiar with Calnex, take a few minutes and just give you a brief overview of who Calnex is. So Calnex designs, produces and markets test instrumentation into the telecommunications sector. What our products are used for is to prove performance of the critical infrastructure of the new networks of the world. Since we started in 2007, we've managed to position ourselves at the forefront of the global test and measurement industry, and we've been successful at selling to all the major subsectors of customers within the telecom space. That's the telecoms operators who run the networks, there's the equipment vendors who generate the various types of network equipment to build the networks, the component people that make sophisticated components, and also increasingly moving forward, also the kind of enterprise and hyperscale companies. These are companies that build their own and operate their own networks, and we've been successful with this group as well. So to date, we've secured orders in over 600 customer sites in 68 countries around the world. If you look at the picture of where test fits into telecoms, test really is involved in everything from when you start designing a new piece of equipment right through to you manufacture, deploy and maintain networks. But the area that we primarily focus on is the R&D, design, validation and conformance testing. This is an area where our testers really enable our customers to get their product to market quickly. So if you're developing a new switch or a router, the quicker you can prove that that's robust, the design is going to work under all conditions, it's going to conform to the standards that you're going to advertise it to conform to, the quicker you can get it into manufacturing and start selling it. So we are an enabler to allow people to get a product to market. And it's an area when you've got the right product at the right time, you can command a healthy price for it because you are enabling people to get their product to market. And it's always about being able to help them with the new technology and do that standards conformance as well as design validation. The one other area that we focus on is maintenance tests. So this is after networks are installed, after initial maintenance, which is usually these days heavily involved in just replacing equipment or doing straightforward tests. If you've got a problem in your network that just won't be fixed by swapping cards out, then you need to have deep insight into what's going on in the network at that point that's causing the problem. And we provide testers that give them that deep insight. And that ties into the ethos and the value proposition of the testers that we do in the R&D space as well. Now, if you look at our customer base, it falls into four main sets of people. On the top left, you've got the telecoms equipment vendors. There's some names you'll recognize in that: Ericsson, Nokia, Huawei, Cisco, and they represent roughly 55% of our business. And in these people, they're primarily buying our testers to be used in that R&D and standards conformance test by their R&D teams. The second group of customers in the bottom left is the network operators. These are your BT, AT&T, China Mobile that build and operate huge networks. Of course, they buy a maintenance tester, but they actually all have conformance labs or evaluation labs where they test new equipment before they deploy it in the network. And they use the exact same sort of testers that the R&D teams use in the vendors, in the equipment vendors. So we sell the same solutions that we sell to the vendors and to the operators. And then the third set in the bottom right is the component manufacturers. So these are your Intels, Qualcomms, Broadcoms of this world that make very sophisticated components. And again, they need to do full evaluation of them. They use the same testers that the vendors use to prove performance of their equipment. And they represent about 6 or 7% of our business. And sorry, I should have said the operators are around 15% of our overall turnover. And then the last group, which is more in the low 20%, is the hyperscale and enterprise group. So these are customers that build their own networks and operate their own networks, or the hyperscale guys that are building these huge data farms or data centers. And they also represent an opportunity for us, both for our R&D testers, but also for our network testers as well. Telecoms is an area where it's all about innovation. because fundamentally we hear a lot about 5G and it's presented to the consumer world that it's a spot technology, but it's not. To me, 5G is really a euphemism for how they're going to have to evolve their mobile network to support the smart cities of the future. And that's not a one-off exercise. That's something that's going to have to keep happening for the foreseeable future as more and more applications, more and more devices want to connect into the network and pass huge amounts of data through the network. So there's a huge amount of innovation going on there. And it's not just in the radio part of the network, but the whole infrastructure behind is having to change and get restructured to be able to support what's needed at the edge of the network, but supported at a price that the operators can deliver profit themselves to. And they do that through innovation, coming up with new types of equipment, new architectures, new topologies, new standards that allows them to do that. And that's really what's been happening for all the years I've been involved in telecoms, and it continues to get driven. And very much that expansion of the mobile infrastructure is what's driving the network evolution today. The other thing that's a huge driver is the whole movement to use cloud computing, pushing huge amounts of data into these central locations where data is managed. Again, there's a huge drive to actually continue doing more and more of that, and it's causing the infrastructure to have to continue to evolve to meet that, moving to higher and higher interface rates. So these are some of the drivers that are really driving our business at the moment. And as long as the network and people keep innovating and coming up with new networks, new equipment, then they need new test solutions, and that's what gives us opportunity. And we spend a lot of time staying connected to the thought leaders across the industry so that we can see what's happening and therefore see opportunities and innovate new products to meet the ever-changing need of the telecoms world. So that's Calnex in a nutshell who we are. So what happened in FY21? Well, to FY21, although it's been a difficult backdrop, we've actually had an exceptional year. We had a huge growth in our business, 31% in revenue grew over the period. And that really has been partly due to the fact that we've been successful in everything we've done, which is not something that happens all the time, but it's happened last year. All our product lines exceeded targets. In all regions, they all grew very well. And we've seen no real negative effect from COVID, I'm pleased to say. We fairly quickly transitioned into working from home as a company. And more importantly, our customers fairly quickly transitioned into working from home. So we didn't see their projects slowing down or their investment in new projects slowing down, which meant they needed new test equipment. It kept going. In fact, if anything, we've seen two positive effects kick in that are real exceptional items in this particular year. First of all, we believe a pull-through of between 0.8 and 1.1 million of orders where customers increased their spending on test equipment. Now, that might seem a bit peculiar, but there is a strange dynamic that happens in our world where, especially in the large companies, and as you know, in every sector, when people think there's trouble coming, financial trouble, they clamp down on capital spend. So what we see, and we've seen this many times in the past, where the engineering teams, and they buy our equipment out of capital spend, if they think they may get their budgets reduced or frozen, they spend quickly. And we actually think this is what's happened this year, that some of that spend has actually come forward. So we've seen some customers that have spent more than we expected them to spend. The other thing that was very different is that we didn't travel at all. Now, we travel a lot because it's a very technical sale with our product. We actually meet our customers, and that's important not only to get the sale, but to build that understanding of what's happening in the market. And of course, travel was severely restricted in the last year. So we basically spent around 400k less on travel than we would have. So the combination of the upside in the revenue of about $1 million of revenue, which drops down to about 600k in terms of profit, plus the additional benefit of not traveling, meant we also seen an upside in profit and PBT of about $1 million. So it's been with every product line doing well, and actually this strange positive effect we got from the COVID as well. That's what's created such an exceptional year and an outstanding set of results. And of course, in the back of all that, we just decided to float the company in the AIM market as well last year, which allowed us, in the combination of that, additional revenue and the funds we raised from the float, is to increase our cash by 9 million over the year. Part of what we said when we floated the company was part of the reason to do it was to expand our business development and R&D teams and invest in these groups, and we have been doing that across the board. So we've already, last year, we've onboarded around 25 people through the lockdown, which was really quite an achievement. It was something we were really worried about, trying to onboard people when we couldn't meet them very often. But the guys did a tremendous job, and it's been very successful, and we expect to finish that growth through the first half of this year as well. We've also seen over a history, when you grow quickly, that many, from a process point of view, you need to be careful that as you go through a growth transition, that your processes continue to work and you continue to be effective as a team. So we invested in our quality management system heavily over the last year as well, to promote that continuous improvement, always looking to do things better than what we've done before. The other thing that actually was reassuring from last year was the fact that actually a lot of our underlying metrics that we look at didn't really change. So all the trajectories in terms of, and Ashleigh will talk about these a bit more later, in terms of the level of repeat business that we've seen, the number of new customers, the kind of split of the business across the various regions. The trajectories that we've seen in the previous years just continued through the year this year. So very much on that side, it was business as usual for us, which again is actually good given the situation that's happening in the world. We were pleased to see these trajectories continue and give us confidence moving forward. We have two major relationships where we work with Spirent Communications as a sales channel partner for us, and we also work with a contract manufacturer, Calnex Electronics. Through the last year, we've both worked with both these companies for a number of years, and these relationships stay strong, and we expect them to continue and be key to us moving forward as well. And as I've already mentioned, we moved into the working from home. It's been very successful for us. Things have gone well. And I think, like a lot of people, there's been a lot of learnings over the last year of how we can all work more effectively, help people to balance their work-life balance, but actually get a business that benefit from that as well. So we've already started to develop what we call a hybrid working model. When we go back, we are expecting people to come back in the office, but we're expecting to have a much higher level of home working happening as we move forward. So we're preparing for the point when we're allowed to start coming back into the office, so that we can get the best of both worlds there. Just a quick look at from our product lines. We've got 3 product families, and all 3 of them did really well. We've got a lab sync, which is used in that R&D design conformance sector, and it tests the synchronization. It's the market leader, and it continues to be the market leader with our Paragon Neo. And we're seeing good traction, good growth. We're seeing more customers coming into that arena. There is initiatives called the ORAN, which is about open radio access network. Up until now, the equipment right at the edge of the mobile network has been dominated by the 3 large players, Huawei, Ericsson and Nokia, and there's a move to try and get more companies involved in that. It's unclear exactly how much that'll change the dynamics of the industry moving forward. We need to let that play out for another year or 2, but more companies are definitely becoming involved, and that means more people needing test equipment, so it's all good for us. In our cloud and IT space, we've seen the SNE had a great year. That's a product that provides high complexity in terms of emulating different network scenarios that allows it to prove performance of equipment. And what our marketing team have really focused on in the last year is taking that product and presenting it more application focused than we have in the past. And that's been really successful. Rather than saying, here's a general purpose toolkit, you can do lots of things. It's kind of saying you're building a kitchen, here's how you use this to build a kitchen with this toolkit. And we've taken it in a targeted particular, where we see the growth segments, and presented it in a way that the customers could see better how to use our product, and that's gone well. And we continue to plan to invest in our marketing activities to do that. And then finally, our Field Sync product. Again, the whole 5G is really only starting to come into that maintenance phase, and we're still selling our product into maintaining the 3G and 4G networks. But we're actually also seeing, as I mentioned, the data centers. In the data centers, they're distributing time across the data centers. And these data centers are so huge, it's like a mini network. And they're using our product in the data centers to prove they've got accurate time across the whole of the data center. So again, we're seeing new opportunities for us there as well, which we're pleased about. So at that point, I'm going to hand on to Ashleigh, and she's going to cover in a bit more detail some of the financial results.
Thanks, Tommy. So through these next few slides, I want to take you through the financial KPIs and then our revenue model KPIs, where you can see different elements of our revenue drivers. And then after that, I'll take you on to the detail on the P&L and the cash flow slides. So as Tommy has already said, and as you can see from the KPI snapshot here, Calnex has had a very strong financial performance in the year. Revenues of just under 18 million in the year grew 31% on FY20, which in itself grew 31% on FY19 as well. And as Tommy mentioned earlier, we saw order intake and revenue performance increase across all product lines in the year. And that revenue figure has been supplemented by the early pull through of what we believe to be 0.8 million to 1.1 million of orders and revenue from FY22 into FY21. Gross profit also grew by 31%. That's very much driven by the top line performance. The margin, although can move about a percentage point or two, it's all mix related. So our margins are very much in line with the average of the last 2 years. So the performance on the top line dropped through to gross profit. And we ended the year with 28% adjusted PBT. So that's PBT adjusted for exceptional costs from the IPO. And that is aided by the savings in travel and events costs that Tommy mentioned earlier, plus the profit effect of the early pull-through of revenues from FY22. Statutory diluted EPS is sitting at 4.18 pence per share, but if that's adjusted for the IPO costs and the related tax deductions, adjusted EPS is actually sitting at 5.21 pence for the year, compared to 3.66 pence last year. And then the strong trading performance, supplemented by the net £4.9 million of funds raised at IPO, drove the cash balance to £12.7 million at the end of the year, which, as Tommy said as well, an increase of 9 million from 3.7 million at the end of FY20. And also within that net cash number of 9 million, we also spent 3.3 on R&D, and that was an increase of 0.4 million on last year as we start the next phase of ramp up and investment in our R&D teams. So just on to the revenue and customer metrics, just to give you more of an idea of our revenue drivers. And as you'll know I've seen from the IPO data, our global customer base and distributor network leads us to have 3 main geographic regions or segments: Americas, North Asia, and rest of the world. And the average spread of orders across these regions usually sits evenly at a third across each. And FY21 was really no different. You can see from the graph in the top left there that we've an almost split of orders again across the 3 divisions, which just allows us to maintain that spread of risk. Also, an IPO showed a lot of our customers are telecoms customers, and you'll have seen that from previous slides. But a growing proportion of our customer base is coming from the non-telecom sectors, which include those hyperscale and enterprise customers on the previous slide. So that in FY20, 22% of our orders came from these non-telecoms customers, and that's now grown to 23%, which just shows a steady increasing trend. And our top 10 customers have contributed to 49% on average of our revenues across the last 3 years, compared to a prior year average of 48%. So very much in line, nothing drastically changed there. We have a high level of repeat demand from these particular customers, as well as our whole customer base. But for the top 10 customers, the average length of relationship we have with them is 9 years, which just serves to demonstrate that repeat demand. And then across the whole of our customer base, the repeat revenue chart here in the bottom right shows the last 3 years average repeat revenues generated to March 21 was 80%, which is very much in line with what we showed at IPO for the previous 3 years averages. And that was all whilst our customer base continued to grow from 177 revenue generating customers in FY20 to 192 revenue generating customers in FY21. Just onto the income statement, just to show you that in a little bit more detail. As you'll know, Calnex generates revenues through the sale of bundled hardware and software, as well as software support and extended warranty programs. And the graph just on the right here shows the split of those revenue streams in FY21. And as you can see, that split is very much in line with previous years in FY20 and 19, showing, generally speaking, a 90-10 split between bundled hardware and software revenues being the 90% and the software support and extended warranty programs being around 10%. As you can see from the income statement and from the KPIs I just talked about, revenues generated in FY21 were 18 million. And then just dropping down to the gross margin here, you can see that was 78%, and I mentioned that was in line with previous years. The gross margins can fluctuate through the year depending on the mix, and then that's the mix of products and the mix of the hardware and software bundles within those product ranges. So we see the 78% very much in line with last year. Administrative costs, excluding depreciation, amortization, and adjusting for the exceptional costs, which were the IPO costs that I'll cover in just a second, were 6.5 million in FY21 compared to 4.8 million in FY20. And that increase in admin costs is driven by a few things, predominantly the increased staff costs as we built the teams across the business, higher sales team commissions just as our orders grew on the previous year. We had higher professional fees and share incentive scheme costs as part of being a business listed on AIM. We had some increased foreign exchange costs just because of the things that were happening in the US dollar to GBP market there. And that was offset by savings in travel and events, which was mentioned already as a result of everyone working from home. Amortization of R&D costs increased by 0.3 million in FY21 compared to the previous year, very much in line with our increases in R&D investment and in this year in FY21 and the previous years before that. And as you'll know, the R&D spend is capitalised and amortised over 5 years. So it's that 5-year effect coming through. One-off exceptional costs, as I mentioned, is IPO fees of 1.1 million and free shares that we bought under the HMRC SIP scheme on IPO and gifted to staff, and some share-based payments in relation to the share options that were in issue prior to IPO. And then the strong trading performance and savings we made on travel as a result of COVID led to an adjusted profit before tax, just dropping right through to 5.1 million in the period compared to 3.5 million last year. And as Tommy mentioned before, that has been supplemented by the profit effect of the early pull through of the revenues coming through, plus the 0.4 million of travel and events cost savings that we made in the year. Just very quickly on the tax charge, you'll notice is a lot lower than last year, 194k compared to 694k in FY20. It's very much driven by tax relief we received on the share options, the UK-based employee share options that were exercised as part of the IPO. Over 15% of the effective tax rate is reduced by that tax relief, which will be a one-off occurrence in this year, and until we exercise more options in future years, it won't affect the next few years. We've also done an exercise on our R&D tax credits just to see if we can leverage off both schemes at the same time. In previous years, we've been heavily reliant on the large company scheme, the RDEC scheme, due to our high level of grant funding. This year, we've been able to still earn on the RDEC scheme, but take advantage of some of our projects that don't fall within that grant funding, and take advantage of the SME scheme, which allows us to take a 130% accelerated deduction on anything that falls into that bucket. So that's had a positive effect on our tax charge as well. But we would expect tax charge in future years to come back to that normal effective tax rate of 19 to 20%. And then onto the cash flow, you can see from the cash flow very much driven by the trading performance in the period and the IPO. Just very briefly, net cash generated from operations was 9.1 in the period. And you can see the working capital contributed quite heavily to that as well. Working capital movements represent stock increases that are just in line with the normal growth in shipments. We've had some good timely payments on debtors, which has been great. Increases in deferred warranty balances, basically because of growth in our warranty and support revenues or orders. And we've got some accrued grant income and year-end bonus accruals in there, which just increases that working capital inflow there. Cash used in investing activities, as you'll know, is predominantly cash spent on R&D, which is capitalised and amortised over 5 years. And that was, as I mentioned before, 3.3 million in the year and 19% of revenues. And cash earned on financing activities in the year was 3.3 million compared to a cash spend of 0.8 million last year. And that's predominantly driven, as you'll see, by the IPO funds raised. The new shares issued on listing raised 6 million before expenses, and net after expenses was 4.9 million. And we also raised 0.3 million on the exercise of the employees' share options. We also received some grant funding upfront from Scottish Enterprise. We have a grant in place with them to take us to January 2023. We received some of that cash upfront, but we obviously aren't allowed to recognise that revenue until we're allowed to take that through the revenue recognition process. The outstanding balance on the term loan of 1.9 million, as you'll know, was paid off immediately post-IPO and replaced with a 3 million revolving credit facility, which is in place but currently undrawn. And that all led us to a closing cash balance of 12.7 million, which leaves us in a very strong position leading into FY22. I'll pass you back to Tommy for the rest of the slides.
So, what are we looking at as we go into FY22? Our strategy remains the same. It's heavily focused on what's happening, the changes being driven by 5G and the cloud computing. This year, I think in all three programs, we have some exciting releases coming out, and a lab sync we're going to be supporting in the middle of the year, around August, September. We're going to release our support for the very high-speed interfaces, 400 gigs, and a number of other interfaces associated with that. And that really should allow us to continue to drive the lab sync program, make sure we keep that leadership position in the market space and continue to grow the opportunity. In the field sync product, again, the 5G is really starting to come into the maintenance space. We've got a new, almost our second generation version of what we call over the air, where we actually listen to the air signal and extract the timing from that. And that'll be able to cope with 5G signal structures as well as 3G and 4G as well. And of course, as I mentioned, we're continuing to push that product as well into the cloud computing space as well, because the data comms guys are actually interested in timing as well. But within our cloud computing, again, we see a number of opportunities coming there. Again, from a marketing point of view, really look at where the growth parts are in the market, and take very much an applications focused approach to our marketing. We're going to have in the second half of the year a virtual version of our emulator. So we're going to have a high-end performance version in the Aotearoa. We've got a high complexity version of it for people who want to emulate very complex networks in the SNE. And then we're going to have as well the virtual version. So as the industry moves forward and moves towards the virtual world, we are ready to go with it as and when it decides to go that way. And of course, M&A is still part of our strategy as well. We continue to engage with other companies in the industry, looking for the company that's got the right products at the right time. They'll actually expand our addressable market, either getting us into a new customer set or actually having more things to sell to the people that we already tend to sell to obviously get more access to more of the money on the table from these people. So looking forward into 22 or to finish in 21, 21 was an exceptional year for us. And it was exceptional just because everything seemed to work. The work from home, going to work from home seemed to work fine. But in the business sense, our product lines all did well. All the regions kept going, and then you've got that upside effect that we got from the pull through of orders and that travelling. Just all came together to create a tremendous year for FY21. When we look into 22, when you take into account of that million and reset it, you can see that the growth trend's still there. There's nothing to believe that the growth trends under the telecoms have been changed at all in the last year. If anything, they've been strengthened by the fact that we all now understand how important telecoms is to us. So we still feel confident there that we've got good products, we're in the right place, we've got good customer engagements, and we can still continue to look forward, find new opportunities and create new growth opportunities, as well as to continue to grow the product lines we have in the market spaces we are today. So at that, I'm going to stop talking and see if anybody's got any questions.
And we have a question from Kai Korschelt at Canaccord.
Hi, Tommy. Hi, Ashleigh. I had a couple of questions. Really, the first one was around the, growth expectations this year. I think you highlighted, you had a pretty strong base, some pull in orders, but, when all said and done, sort of general demand activity still seems to be pretty strong. So I'm just wondering kind of what organic growth, would you potentially expect? And then perhaps FX also is a bit of a headwind at the moment, I guess. So that was my first question. And the second was around the upcoming 400G product launch. Tommy, if you could maybe just give a bit more color around potential target markets. I understand it's, both, service providers, but also in the data center space, the sort of activity to roll this out is there. So I'm just wondering kind of, what are your expectations both internally for the product, both in terms of, new customer wins and perhaps growth contribution, etc. Thank you.
Okay. Yeah, we still believe that the underlying drivers in the market say that we should be growing around, the kind of mid to low to mid teens every year. So and when you take that million that we believe is pulled forward, we're still projecting to stay on that path. Now, we've had the last 2 years has just been extraordinary growth for us. And, I think we need to keep driving to deliver that sort of growth, but we need to find new products and new places to continue to do that. So we feel confident that we are on a good trajectory. I think you do need to look through 3 or 4 years to see what that trajectory is and not narrow in and just on the last year, because I think to assume that we can do 20 and then 30 and then 20 again, perhaps I'm getting drunk on my own hype at that point, to believe that that's what's achievable in the market space. But that doesn't mean to say we're not driving to find new customers and new opportunities to continue to deliver that sort of business moving forward. In terms of the 400 gigs, in some ways, if you listen to some of the other people, 400 gigs has been around for a while, but because we do this synchronization test, it is actually, you have to wait until the technology is available for us to be able to build the solution, because it is a very difficult thing to do. And in that arena, we've very much seen the datacoms, the data center guys are driving hard to get to these high-speed interfaces, because if they go to higher speed, they can move more data about, and that's what they believe is a better way to go. So it's primarily into the people that deliver on switches and routers, both for the telecom space, because the telecoms networks move into these higher rates as well as into the data centers. And there's actually a combination there, although the headline's 400 gigs because that's the top rate, and at the moment we do 100 gigs, but actually by coming out with this interface, we also do 200 gigs and we do 50 gigs. And there's another interface that's referred to as PAM4. Up until this point in the world, optical interfaces are quite simple. Either the light's on or it's off, it's 1 or 0. Well, they've changed and they've got what's called PAM4, and effectively there's 4 levels of on or off. So for the same clock rate, effectively you can get twice the amount of data down the piece of fibre. So that's another innovative piece of technology that's allowing them to continue to push the boundaries of what's possible. And we're going to support PAM4 as well as 50 gigs, 200 gigs, and 400 gigs. So again, we would expect to sell this into our current base of people, our customers that we've been selling to, our LabSync products in the past. We would be going to these guys to sell, but we hopefully see a number of other customers coming in the market that'll be interested in this product as well.
Okay, that's great. Thank you very much, and congratulations again.
And we'll go to Kevin Ashton at N+1 Singer.
Good morning, Tommy. Good morning, Ashleigh. Just 2 brief ones from me. Looking at Paragon Neo, is it a relevant product to everybody who owns Paragon X? Is it a kind of natural upgrade, or is it just different use cases? So some of the Paragon X install base wouldn't necessarily think of upgrading, or is it something that just over time, naturally, given what they're doing, you would probably expect them to migrate? And then the second question is the one that everybody's asking, is the component side of things. Just if you've got any view on that. I mean, it's getting quite serious for some people and expected to go on for a long time, the shortage. But any thoughts you have on that would be interesting too, Tommy.
Yeah, no problem, Kevin. Nice to speak to you again. So the answer to the first one is yes. So there is a kind of it probably is nearly yes or almost yes. So you're right. Most people that are working at the lower rates through time move to the higher rates, and it is a different spectrum. So you will see the kind of market leaders, your people like Cisco's and Huawei's, they always want to be at the front edge of any new data wave because that's part of the ethos of who they are. They offer the leading edge. So they're first to 400 gigs. They're pushing to 800 gigs now. But then there's a whole bunch of other companies that come along behind and do it. So we would expect, in some ways, everybody that's bought a Paragon X in the past, unless they've fundamentally changed their strategy or direction, is likely at some point to want to move on and move into the Neo. So very much with that installed base out there, it gives us a very strong hold. And, you know, in terms of, as we've talked about before, these products are quite complex to drive. People create, and they build them into test racks where they run automated test scripts. So each time they release a new software release for their product, they rerun a lot of tests to make sure the new features they've added work, but also making sure they haven't broken anything inadvertently that they didn't mean to change. And so our racks sit there, our equipment sits in the racks and runs these automatic test scripts. So again, once you get into it with a customer, they've invested writing all these scripts. We make sure that when you use scripts to drive a Paragon X, you can use the same ones to drive a Paragon Neo, albeit maybe some of the factors need to change. So that kind of connectivity to the customer, connection, stickiness is really important, and allows us to hopefully keep going forward and keep growing and very much keep selling to the people who sold in the past. And you can see by the kind of 80% repeat business that we do keep selling to the same people, as well as always striving to find new people. The component world, you know, in some ways, it's been a two-part story. I'm sure everybody's seen at the start of last year when the pandemic kicked in, there was companies had trouble with material shortages. We weren't really affected by that. I think it was mainly the people that did just-in-time type manufacturing, where they moved stuff through very quickly. Because our products are high complexity, low volume, and a lot of our parts are long lead times, we tend to sit with quite high levels of inventory in terms of months worth of inventory. And, you know, typically we've kind of forecast, our contract manufacturer tries to build for what we need in the next 6 months. Now, obviously, we are starting to see lead times moving up. And I think there maybe is a bit of a toilet roll effect happening here where, you know, there's a shortage. We've done the same, we've turned up all our forecasts. Everybody turns the forecasts up and tries to buy more, and that causes a bit of a shortage. So at the moment, we don't have any direct problem. I think everybody that's involved in procurement's got a slight nervousness at the moment. What's happening? Is there a toilet roll effect that will clear after 4 or 5 months? Or is there something that's far more fundamental going on there? And so we're working hard with our contract manufacturer to make sure we're trying to increase the stock that we've got, especially of the critical components, to make sure we've got the stock to continue to deliver product to the market moving forward.
That's really helpful, thanks. And if I can just follow up quickly on the Paragon X, Paragon Neo. I think I remember from something you said before, there are about 1,000 Paragon X boxes out there. In terms of where you've got to on Neo, it's presumably what 5-10% of that maximum? I don't know if you're happy to talk about that.
Yeah, that probably number 10, probably into kind of low 10, low teens percentage is probably where we are at the moment. So we're still at a pretty early stage of kind of refreshing that whole base. But of course, it's always a bit dangerous to kind of compare them as like markets. I think a lot of companies have changed what they're doing as well. So we're still at a very early stage of if you call it a refresh there. In terms of, if you look at the sheer numbers that we've sold, we're still in that kind of low teens sort of position.
Brilliant. Thank you both very much.
And we'll go to David Johnson at Allenby.
Hi. Quick question on the pulled forward projects. Were they evenly spread across the kind of 4 different groups of customers that you identified, or are there slightly different dynamics at play if it's hyperscale versus telecoms operators, components? I'm just thinking kind of their purchasing profile and the dynamics at play.
Yeah, there was, in terms of our top 10 customers that we've sold to for many years, there was 3 in particular, and they were all more in the vendor space that actually seemed to increase their spending a lot more than we expected them to do. So it was more in that network vendors, equipment vendor space, rather than in the hyperscale space that we see. To be fair, we actually seen a couple of customers that seemed to reduce their spend as well, not to the same degree. And again, we would hope we've already started to see them. You know, in some ways, I just see this as kind of ripples on the pond. There's always things that change people's opinion on exactly when they're going to spend money, what they're up to. And so, you know, we don't feel there's a kind of underlying change to the dynamics of the market. It's more just a a reaction to what's been happening in the world over the last year.
Thank you.
And we'll go to Ian McAnally from Senkos.
Thanks. Good morning, both. Just a quick question on the next generation of emulators and what's happening with virtualized product, virtual SME and so on, and what the plans are for that. Is that something that's going to be cloud-based from your end, or is it effectively a shrink-wrap software sale and something that happens at their end? Are you getting into a sort of cloud services element with the software side of things?
It's a good question, Ian. We'll present it to the world in probably in multiple ways. The customer base, you'll still be able to buy it as a standalone sale, as an upfront purchase, where you just buy it, because a lot of the engineering teams want to do that, and especially into the traditional base that we find, because actually things like our Paragon product, you can buy it on a timed license basis. But our customer base does not like that sort of approach. Because of this capital budget, they're never quite sure what they're going to have next year. If they've got it all tied into having to buy recurring licenses, then they can find themselves they haven't got a lot of bandwidth for the kind of flexibility they need. So what we use it very effectively for is to allow them to buy, the base, a number of options up front. We may give them free licenses, and then in the next quarter they give us the rest of the money by buying the licenses. Now that's not committed in terms of contractual, but if they don't buy the licenses, the product effectively switches itself off, and then they've got a very expensive doorstop. So we kind of don't use the time licenses much as a model. It's an effective model from the sales process point of view, but it's not something we would see switching. Now, when we start to sell more into enterprise, and people running in the cloud, it may well be that we see there's a different cost model or a model that they want to work with. They want to use a license model. So we plan to bring it to market where you can either buy it as a licensed product or you can buy it as a standalone purchase. And we'll be guided by what our customers want it to be.
Thanks.
And we'll go to Sam Butcher at ACF Equity.
Hi, thank you, Ashleigh and Tommy, for the presentation. Just had a quick question. So do you expect a stronger pound to be an FX translational issue over the coming months as the UK economy is expected to show strong general growth?
We kind of build that into our financial planning. You're right. A lot of our business is done in US dollars, and a lot of our expenses is in pounds. So, it suits us when the dollar, when the pound weakens. That's in general, that's good for us. So, we've kind of we can see that the currency's heading what way it's going. It's one of these things. We've got some natural hedging in what we do and the way we buy material. We obviously have got team members across the world that we pay in US dollars. So within our financial planning, we've assumed that the pound's going to go against us as we've built the plan for next year. But we don't expect, in some ways, if you look back over the last year, it actually went from at the start of last year, it was about 1.32 or 1.28, Ashleigh, I think.
Yeah, just like that.
But 1.28 and went to 1.38, and yet we still managed to deliver the performance we did, even though the currency was going against us through that time. So it's just a fact of life. We just need to live with it and plan the best we can for it.
Okay, thank you.
And that's the end of questions. Tommy, do you have any closing remarks?
Yeah, I'd just like to thank everybody for coming along. Hopefully that was, we managed to answer all your questions for you. It's been we're still new to this game. This is our first full year results session. We're only 6 months, but it's been an interesting journey, and it's been a great year to come to market. I think the fact that our business has been so strong, the fact that in every product line we've done well, the underlying drivers seem to be there, which is always key, and across all the products and across all the regions. So, we're really pleased with what we managed to achieve last year, and we go into this year, FY22, with confidence that we can hopefully do quite well again this year. So thanks very much for everyone for coming along.